Hello and welcome to this month's market update for April 2025. My name is Steve Latham. I am the Chief Investment Officer for Bernanke Wealth Management. And wow, there's been a lot going on in the market these last couple weeks. Just to let you know where we're at today, as of this recording, it is Thursday, April 10th, and we have just rallied 9% after falling around 15% on the S&P 500. Today, this Thursday, we are down about 3% on the S&P as of the time of this recording. So like I said, there's no shortage of things to talk about as it relates to trade, tariffs, the economy, inflation. Really pick your poison. We can do an entire video on that. But what I want to focus on for this month is how trade works between the United States and our international trading partners. Just to set up some definitions so that as we hear about what's going on in the news and the day-to-day media, we have an idea of these terms that are being talked about, and we all are on the same page as far as where the United States sits as far as trade with our international partners is concerned. So let's define a couple of the terms that we've heard commonly used over the last couple weeks to say what America's trade status is with our international partners. First, let's look at what a trade deficit means. And all that means is if we are importing more from an international partner versus what we are exporting to them, that means we are in a trade deficit. We are buying more of their goods than they are buying of our goods. The opposite would be true with a trade surplus. That means we are exporting more to the country that we are trading with than we are buying from them. And on balance, if you look at this on a global scale, you can see through this chart that we import quite a bit more than we export overall. Every country that has a blue tinge to them is a country that we have a trade deficit with, meaning that we are buying more of their goods than they are buying of our goods. And when you look at this in total, our total trade deficit with our global trading partners is around $900 billion. Now, if you break that down further, we can see where a goods trade deficit is actually $1.2 trillion, meaning that we buy a lot more goods that are produced internationally than we sell internationally. However, we have a surplus in services, meaning that other countries buy more of our services than we ship overseas. And so when we look at this on a country by country basis, this is where you can see why some countries are called out more than other countries. China is right up at the top with a trade deficit with the United States of $263 billion as of 2024. Now, all that means is we are buying $263 billion more of their goods and services than they are buying from us. And you can go down the list for other countries that we are also in a significant trade deficit with, Mexico and Vietnam being the next on the list as far as who we are buying more from than we are selling to. Now, deficits are not necessarily a bad thing. Over the last 20 to 30 years, the world has really engaged in specialization as far as who is producing what. So that means some countries have been able to get goods manufacturing down to a level that it's far cheaper for them to produce the goods and have them imported to other countries, while other countries, like the United States, has done quite a bit better job of producing services like financial services and other trade-related services. What we want to do is show over the last 30 years or really 40 years where we've come from and where we're at today. We in the 1980s actually had a relatively balanced trade surplus and deficit. So we were balanced really across the board. Ever since then, whenever we've seen other countries specialize in certain areas and other emerging markets really focused on their export needs in order to grow their country, we start to see the United States buying more from other countries because our companies based in the United States have been leveraging the cheaper manufacturing costs overseas. And you can see over the years that it's kind of skipped around a little bit, but by far, if you look at the trend has been moving towards a trade deficit, and we are now at the largest trade deficit that we've been over the last 45 years. Again, a lot of that comes from the goods side, because we are shipping out more services than we are pulling in, but that goes back to the specialization of other countries. Now, a lot of the reason why we're talking about this right now is because the specialization and perhaps more of the government intermingling of what those individual companies are doing has provided an uneven playing field. And the way that you want to look at it is how other countries have tariffed United States goods versus how we have been tariffing their goods. And JP Morgan has created a really nice chart that shows the average trade-weighted tariff for what countries are charging us versus what the United States is charging to other countries. And so if you look at the chart here in front of you, on the left side, we have the rate of tariffs charged by the United States to other countries. And then on the bottom, we have the rate of tariffs charged to the United States by other countries. And what you see here is most countries do have a larger tariff on the United States than the United States has on them. Now, if you look at the percentages here, the tariffs aren't terribly large on a trade-weighted basis. And what do I mean by trade-weighted? Well, all that means is if you have a 20% tariff on a good, and that good represents 10% of that country's imports, well, overall, your trade-weighted tariff is only 2% because your 20% tariff is only on 10% of the goods. So that's how these numbers break down here, and that's where you can see countries like Canada, the European Union, they have average trade-weighted tariffs of anywhere between 2 and 3%, even though you may hear headline numbers of they're tariffing our cars by 10% or metals by 25%, whatever the case may be. We're averaging that out across all the goods and services that are being traded between the two countries. So the intent for the tariffs right now, at least from the United States side, is to try to even the playing field, move some of these countries up and to the left so that the line of reciprocity, which is what is shown here in this chart, is more in the middle for what we are doing with our largest trade partners. Now, the biggest thing to keep in mind whenever we're seeing these headlines, seeing the trade-related noise coming through, is that we need to take a long-term outlook at what is happening. For better or for worse, what we're experiencing right now is volatility, and that is normal in a market. We've often seen corrections of 10% or more in the stock market on average around 1 to 2 years. So it's not uncommon for these things to happen. Corrections of 20% in the stock market have happened 7 times over the last 30 years. So these aren't uncommon phenomena, and we need to know that as these pieces of news come across the desk and the market reacts to that, this is, for all intents and purposes, temporary whenever we're looking at this over a long period of time. Now, we can agree or disagree with how these are being implemented and how trade is evolving over the global scale. But for the time being, as investors, whenever we're looking at what we're doing in our portfolios, we don't want to make rash decisions around day-to-day moves in the market, especially whenever you see the market as volatile as it has been this week, where we've had a down day of 3%, an up day of 9%, and now another down day of 3%. Being in and out of the market can really make you miss out on these larger moves, especially once calm returns to the broader markets. So if you have any questions around what's happening with tariffs, what's happening on the global scale as far as trade's concerned, please don't hesitate to reach out. We'd always be happy to answer your questions for you. Take care. Thank you very much.